Let me introduce you to someone you probably know. We'll call him Mark. Mark has been trading for about 2 years. And in market terms, that makes Mark a toddler who just discovered matches and gasoline at the same time. Mark's portfolio is up 13% year to date. He hit a lucky trade on a crypto meme coin, and his confidence is absolutely unhinged. Mark watches The Wolf of Wall Street like it's a documentary. He explains emerging biotech to strangers at bars. And yes, he thinks options are a cheat code, not a loaded gun. So naturally, Dave decides he's ready to go pro. He calls his broker, inflates his net worth, clicks through the risk disclosures without reading a single sentence. And boom, he's approved for options trading. Fast forward 3 months. Mark is now fully leveraged into out-of-the-money Tesla calls. His strategy, buy high, sell higher. His risk management, hope. His exit plan, there isn't one. His wife, meanwhile, has a different question. Why is $13,000 missing from our savings account? Fast forward again. The Federal Reserve hikes rates. Liquidity tightens. Momentum stalls. Mark's portfolio is now down 67%. And his wife's new hobby is Googling how to divorce a man who refers to himself as a market wizard. Which brings us to today's real question. Why do the dumbest investors seem to win? The illusion of skill. Here's the uncomfortable truth most people don't want to hear. Since 2020, you could have bought almost anything and made money. The stocks, crypto, the SPACs, unprofitable tech companies trading at valuations that would have gotten laughed out of the room a decade ago. And if you were aggressively risky, like Mark, you probably outperformed conservative investors. Not because you were smart, but because the environment rewarded recklessness. This is where the Dunning-Kruger effect comes in. It explains why people with the least experience tend to be the most confident. Why are people with real experience more cautious? And why Dave genuinely believes market manipulation, not bad positioning, is why his calls expired worthless. In a massive liquidity-driven bull market, luck looks exactly like skill. The market context everyone ignores. Let's zoom out. Since the 2009 bottom, the S&P 500 has returned over 700%. That's not normal. That's not average. That's not repeatable. We've lived through zero interest rates, quantitative easing, pandemic stimulus, retail trading apps, a flood of speculative capital. For over a decade, the market rewarded one thing above all else: beta. What beta actually is and why it matters. Beta measures how volatile an asset is relative to the market. A beta of 1 means it moves with the market. A beta above 1 means it moves more than the market. A beta below 1 means it moves less. Example: if the market goes up 2% and a stock has a beta of 1.5, that stock is expected to go up about 3%. That's great when markets are rising. Retail investors naturally gravitate toward high beta stocks, options, leveraged ETFs, crypto, narrative-driven trades. Why? Because they feel excited. They move fast, and they create the illusion of genius. Why dumb strategies outperform in bull markets. In a rising market, risk is rewarded. Volatility works in your favor. Drawdowns are shallow and temporary. So Mark's portfolio looks incredible. He's not diversified. He's not hedged. He's not thinking about probabilities. But it doesn't matter yet. And here's the key insight most channels never explain. Outperformance in bull markets doesn't come from intelligence. It comes from exposure. The investor who takes the most risk wins until the environment changes. Survivorship bias, the graveyard you never see. Here's what social media never shows you. For every Dave bragging about a 10-bagger, there are 10 silent accounts that blew up, thousands of traders who quit quietly, entire portfolios wiped out and never posted. You only see the winners because the losers disappear. That's survivorship bias. And it's why bad strategies look brilliant right up until they don't exist anymore. Why this always ends the same way. Markets move in cycles. Liquidity expands. Risk assets inflate. Speculation increases. Then, rates rise. Liquidity dries up. Volatility spikes. And suddenly, beta stops working. High beta portfolios don't just underperform, they collapse. The same leverage that made Dave look like George Soros now makes him a cautionary Reddit post. The hard truth about blaming the market. When this happens, something predictable follows. Mark doesn't say, I over-leveraged into speculative assets late in the cycle. Mark says, the Fed ruined everything. Market makers manipulated my trades. This was rigged. Because taking responsibility is harder than finding a villain. What smart investors actually do. Here's the difference between experienced investors and Dave. Smart investors understand regime changes. They separate long-term capital from speculation. Use beta intentionally, not emotionally. Reduce leverage before markets force them to. They don't avoid risk. They price it correctly. They know when to press. And more importantly, they know when to step back. Why Buffett looks boring right now. People love mocking Warren Buffett for holding cash. But cash isn't cowardice. Cash is optional. It's the ability to act when others are forced to sell. And that's what most retail investors never have, because they're always all in. So, why do the dumbest investors win? Here's the real answer. They don't. They just win temporarily, in environments designed to reward risk-taking. And when conditions change, the market collects its tuition with interest. Everyone looks like a genius in a bull market. The difference is who's still standing when it ends. Conclusion. If your strategy only works when markets go up, it's not a strategy. It's a bet. And sooner or later, every bet meets reality. So the next time someone brags about their memecoin, their options win, or their overnight fortune, remember. You're not seeing intelligence. You're seeing exposure in a forgiving market. And forgiveness doesn't last forever.